Well, good to see everybody again, and hopefully you enjoyed the day so far. And in keeping with the football theme, I have my eye open for the Federal Express delivery person because I texted Bill Belichick asking if I could borrow his sleeveless hoodie for the afternoon, and I haven't seen the FedEx show up yet, but I'm still hoping for that. But after AI and after Kevin Colbert, the general manager of the best football team in the NFL, I think we're going to step it up in the excitement scale a little bit and do an A&A update. So hopefully you're all ready to roll in that regard. So there's our pictures. We're jumping past that. And we're going to talk about what our objectives are. And this is going to be very similar to before. We're going to discuss current A&A. Yeah, keep blowing that up because I can't see the slides. So bigger, thank you. We're going to talk about recent developments in the FASB. We're going to talk about some other things. It's going to really be highlighting those that relate to private companies. We're going to stay away from public companies. We're going to stay away from anything like the PCAOB. We're going to stay away from international standards, as we have also indicated in other years. We do want to talk about it a little high level. Obviously, you need to be very careful in this context not to confuse what we're talking about with detailed advice. The FASB, somewhat uncharacteristically in my career anyway, has been a little more quiet in the last couple of years than I'm used to, for sure. It's okay. They had some big pronouncements, of course, with the leases and revenue rec, et cetera. And there seems to be a lot more noise on the PCAOB side. So we're going to just weave in a couple of other things that we hope are of interest to you. And that's really going to be kicked off with really the current CPA accountant shortage. It's actually a nationwide issue. Fortune magazine states that the United States is short 340,000 accountants. 340,000 accountants? Some blame the boomers. The boomers are retiring and leaving the profession without, I guess, sufficient replacement. And who knew earlier in our careers that we would be this much in demand, that we would be kind of this special, if you will. And I think that the shortage in accounting majors has had a little short-term blip. I think most of the colleges and universities know and knew of for a long time the demographic cliff that's supposed to get steeper in the next year or so. And I know there's several folks from the different universities here, and they're certainly well aware of that. And I think in a presentation I saw just a couple of months ago at one of those schools, Duquesne to be specific, the dean of the business school showed the cliff, and he showed a little upward blip for maybe it was 2023 and 2024, where there was a little bit of relief in the decline of accounting majors. But then, interestingly enough, right after that, it became very steep, a downward trajectory. So I think the profession and the universities, for sure, have a large interest in stemming that tide and maybe reversing it to the degree that they can. There could be a lot of reasons for that. I think that many talk about the 150 credit hours. And the 150 credit hour requirement, which isn't that new, but it was amongst the things that allowed really portability, be highly aggravating if we all had to be licensed in every state in which we signed an audit report, for example. And I think that from all indications, there's much progress being made on the 150 credit hour thing in various endeavors. And you can read about them. You can look at substitutes, alternate ways to get there, perhaps some modifications to that coming along. But if you just think that through for a moment, if you're a student in maybe freshman year, sophomore year in college, and you're looking at whether I'm doing accounting or finance, and you're deciding which one, and you're pretty torn between them, and you're not really wed to either one. In the accounting side, they say, well, gee, that's nice. And maybe your deal with your parents is you have to pay for part of your education, or maybe your deal because however independent you may be, you have to pay for part of your education. You say, well, you have the pleasure of getting another 20 to 30 credits paying for it. And then, oh, by the way, another issue that happens afterwards is accounting used to be one of the most highly compensated bachelor degree entry-level outcomes from a business school. And it wasn't that long ago. I mean, we were supposed to go away in the late 90s with the whole .com craze, and thankfully the profession survived all that. We were supposed to go away again around 2010 with blockchain was supposed to have made our entire banking and accounting system obsolete. I'm a little hyperbolic, but that's okay for the day. And it also did. So we had this big rise in accounting majors. So to my understanding, post-Enron and into the 20-teens, it for a while was the #1 business major. So now when you say, gee, you got to go to almost an extra year of school, you have to pay for it, and now rather than being the highest or near highest business major undergrad outcome, you're now amongst the lowest. That's really a tough sell, in spite of what many of us think, and I deeply think. I completely underestimated the value of this profession. I admit it. I worked hard to get into the profession. I even appreciated it in my youth a little bit, but I completely underestimated the ability that we have in this profession to chart our own path. Unlike many things, we have the opportunity to work with fascinating people both inside where we practice and outside of our clients. If you're in industry, you're typically part of a fascinating group of people there as well. So I think it's an industry that is underestimated in many regards. But back to that sophomore in college, you get to go to school longer, pay more, get paid less. You can see why it's a little tough sell. That's actually exacerbated by this reputation that accounting is long hours, difficult work-life balance, and all of that. And that reputation was probably hard-earned at some point in time, and in large respect, is somewhat still there, but may or may not be that different than the outcomes with other business majors. But it's just one more thing for the profession to overcome. And the only one I don't really buy, and maybe it's just my perspective, having done this for a while, is this whole assertion that you wouldn't major in this because of this complexity of accounting rules. Okay, well maybe, but it's not like finance is child's play. But the profession is working hard to mitigate all of those. Well, how bad is it? I mean, if you actually look at this particular graph, and this is from the GYF CPE presentation they did, this is probably only about 2 months old, 3 months maybe. And you look at the far left, 2007-ish. I'm not putting the glasses on, we do it just pretty close here. You'll see that the bachelor's degree in accounting graduates made up about 65% of those hired by the profession. And you'll see that the green one, really at the bottom end of the left side of this chart, were the non-accounting majors. They made up a relatively small percentage of the new hires into the accounting profession. Just keep sliding all the way to the right, and look what happens. So, no, obviously, the blue line, the master's in accounting, it kind of holds its own. It's the flattest of the three. But look how that the undergrad, the bachelor's degree accounting majors dropped. And look at the non-accounting majors, how it really ascended. And it's actually higher now than the bachelor degree as accountants. Now, it's also very true that the big four and the big international firms kind of skew that a little bit, as that they do pretty heavy hires outside of traditional accounting undergrads. But even this is becoming a little more and more true at regional firms and other firms. So it's a big deal, and it might be in part a response to the shortage. What's really going to happen with the shortage, or why is it happening? Well, there's a number of reasons. You'll see this graph shows, in the top one, the number of successful CPA candidates, and the next one is the number actually sitting for the exam, and it's plummeting in the last few years. So think of it this way. In general, there are fewer students to go around at the United States universities, and where we live in this country, we have a really cool in a bad way, combination of amongst the most expensive colleges in the nation. I think at least 2 or 3 years ago, Penn State and Pitt were both in the top 5 as far as most expensive in-state tuition for in-state students. So, and we also have a declining population compared to maybe Atlanta or Jacksonville or Austin or wherever. So we have a shrinking pool of people coming into our regional universities. And of those coming in, we have a fewer number of them majoring in accounting. And of that fewer that majors in accounting, we have only about, I don't have this slide in here, but at least as of a year or so ago, historically about 60% of accounting majors ultimately sat for the CPA exam. And more recently, that's down to 40%. So you have a shrinking total, you have a shrinking number of the second tier pool being smaller and the third one also being smaller. So that becomes a big deal, and I think that's why there's so much talk about this. And what are we going to do about it? We already talked about trying to mitigate the 150-hour rule. We talked about having more dollars. And I think that's real. I mean, we certainly felt it, and hopefully to the benefit of our teammates here. And I think one of the big four, but it's Publix, but I'm still not going to mention their name, has gone public in their commitment to over $1 billion over the next couple of years to increase entry-level compensation. And obviously it stands to reason that that will have a ripple effect. It will have they will have to fix the compression factor of that. So I think we can hopefully look forward to some reversing that trend, and hopefully as good of a future for those who come into our profession as many of us have had. So that little talk about the shortage of accountants in the United States at this point in time, I'm going to turn it over to Eric to some of the standards that are actually being implemented right now.
Thanks, Jeff. Before we dive into these various accounting standards updates, I want to start out by mentioning that unlike Mark this morning, I had intended on sharing some football humor throughout this presentation, but after hearing some of Mike's football jokes, I'm hoping my football humor doesn't fall flat like his did. Some in this room might be thankful to hear that these accounting standards updates that we'll cover will not include any discussion on lease accounting. I think we've covered that several years in a row these past few years, so that will not be part of this conversation. As Jeff alluded to earlier, overall it's been a rather light year in 2024 with new accounting standards updates, but we'll look to cover a few of the more impactful ones, as well as a few that were issued in prior years that are becoming applicable. Starting out with ASU 2021-07, this was issued all the way back in October of 2021. This became effective for everyone for years beginning after December 15th, 2021. Relates to private companies only. This was issued in response to stakeholders indicating that determining the grant date fair value of share options awards was costly and complex. Two more notable issues that were raised. The current price input was the most difficult input for private companies to estimate, as well as unobservable market prices for shares. Obviously, since a lot of these companies are not publicly traded. This ASU provides for a practical expedient that allows a private company to use a reasonable valuation method for share-based awards. So what does reasonable valuation mean? There's several factors to consider in determining reasonable valuation. This could be things such as the value of the tangible and intangible assets of the company, present value of anticipated future cash flows, market value of the stock or equity interest in similar companies, as well as recent arm's length transactions involving sale or transfer of stock or equity interests of the entity. Okay, so another one, this is really the only one in 2024 that is of relevance for this presentation. ASU 2024-01 also deals with Topic 718, stock compensation. This was issued in March of 2024 and was the first ASU issued in 2024. This applies to all entities that account for profits, interest awards, which also referred to as units, as compensations to employees or non-employees in return for goods or services. Prior to this ASU, there was difficulty in determining whether a profits interest award should be accounted for as a share-based payment arrangement under Topic 718 here, or similar to a cash bonus or profit sharing arrangement that would be not subject to Topic 718 here. So what are profit interest awards? Some examples of this could include, a piece of the company profits every year to employees, or a piece of the sale price if and when, ownership elects to sell, or a combination of both. This ASU, really at the heart of this ASU, it adds 4 illustrative examples as guidance to demonstrate how an entity determines whether profits, interest, and similar awards should be accounted for under Topic 718 or not. The reasons these illustrative examples were added were because there was complexities in determining whether the profits interest award is subject to Topic 718, as well as existing diversity in practice among these private companies. It's also important to note that there are 2 master glossary terms that are implicated in the FASB's decision on this topic. One, equity instruments are not considered issued until the issuing entity has received the consideration. So what does this really mean? Essentially, this means that the granting of equity instruments subject to vesting requirements is not considered to be issuance. And secondly, a share-based payment award becomes vested at the date the employee's right to receive the award has been satisfied. So a service condition has been met. Market conditions are not vesting conditions. This becomes effective for non-public entities or any entity other than a public entity for years beginning after December 15th, 2025. So we have a little bit of time on this before it becomes effective. So I mentioned 4 illustrative examples. I will go ahead and walk through each of these 4 illustrative examples. All right. Each of these examples labeled Case A, Case B, Case C, Case D, they all share the following assumptions. The entity is a partnership. The entity has Class A units outstanding. The entity grants Class B incentive units to employees in exchange for services. And an exit event is defined as an IPO, a change in control, or a liquidation of the company's assets. So with that, we'll turn our attention to Case A. All right, in this example, Case A, Class B units are profits interest units that are subordinated to Class A units because after vesting, they participate pro rata with the Class A units once the holders of Class A units have received distributions. These Class B units cliff vest at the end of 3 years of service. Upon an exit event, the Class B units vest immediately if a grantee is still providing services. And upon the exit event, the grantee would retain vested Class B units, or if a Class B units are settled through the exit event, the entity would distribute proceeds to the Class B unit holders. So, with some of my football humor, should this be accounted for under topic 718, the booth has initiated a review on this. I still have my 2 challenge flags that Mike said were under our seats. I didn't find those, so I'm going to use my imaginary 2 challenge flags later. The booth initiated a review on this one. Upon further review, the ruling on the field stands. This would be treated under topic 718 because upon 3 years of service or in an exit event, the company will have received the agreed upon consideration. That is, the service conditions are met and the award will vest. Also, holding the vested B units provides the employee with the right to participate in the residual interest of the company through periodic distributions or upon an exit event in which the settlement proceeds are distributed proportionate to the ownership of Class B units of the company. A couple other things here just to consider, some cash flow considerations. This is kind of building off of what we just covered with Case A and really has relevance to each of these cases. If a grantee of the Class B units terminates employment before meeting any vesting requirements, for any reason other than cause, any unvested Class B units will be forfeited for no consideration. If a grantee of the Class B units terminates employment after vesting, the grantee retains the ownership of these vested Class B units, but upon the termination, the company has a call right to repurchase the Class B units. If the call right is exercised, the company would pay the grantee of the Class B units an amount of cash equal to the fair value of the Class B units on the call date. So this would have a cash flow impact, and as mentioned earlier, fair value can be determined using a reasonable valuation method for these private companies. All right, diving into the second case here, Case B. Some additional assumptions. These Class B units are profits interest units that are subordinated to Class A units because once granted, which is different than Class A, which said after vesting, but once granted, they participate pro rata with the Class A units once the holders of Class A units have received distributions. The holder of Class B units is eligible to participate in non-forfeitable operating distributions at the grant date. So this is different than Case A, which was after vesting. Class B units only vest upon an exit event, which under Case A, they vested after 3 years of service, so another difference here. Similar event, upon such an event, the holder retains the vested Class B units, or if Class B units are settled through an exit event, the entity would distribute proceeds to the holders of these Class B units. And lastly, Class B units are forfeitable upon employee's termination for any reason before an exit event, which was not included in Case A. So, should this be accounted for under Topic 718? Once again, the booth is, we're in the final 2 minutes here, and the booth has initiated a review of this. Upon further review, the ruling on the field stands as called. This would be accounted for under Topic 718 because upon an exit event, the company would have received the agreed upon consideration and the awards will vest. And similarly, the holder of the vested Class B units provide the employee with the right to participate in the residual interest of the company through periodic distributions or upon an exit event in which settlement proceeds are distributed proportionate to ownership of Class B units of the company. As mentioned before, it's also important to note that the holder of these Class B units is not entitled to retain the units if the holder ceases to provide services before an exit event. So the Class B units would be forfeited for no consideration. They forfeit their rights to future distributions as well. All right, so the first 2 cases would be accounted for under Topic 718. These next 2 become a little more questionable. Under Case C here, Class B units do not entitle the employees to receive equity instruments of the company, which is different than Case A and Case B. This is often referred to as a phantom share unit. The holder of the Class B units is not eligible to participate in distributions of the company, which is different than Case A and B, where the holder was participating in distributions. The holder of Class B units is eligible to receive cash upon an exit event. Upon such an event, the Class B units vest immediately and must be settled in cash on the basis of the fair value of the Class B units, which fair value is calculated by reference to the price of the Class A units of the company. The holder of the Class B units must be providing services upon the exit event to receive the proceeds. And similar to Case B, the Class B units are forfeitable upon employee termination before an exit event. So, as Mike alluded, I'm going to go ahead and throw one of my challenge flags that were under my seat. Under further review, let's look at this a little closer with how this would be accounted for or treated. So the Class B units, they do not meet the condition under Topic 718 because they do not entitle the employee to receive any sort of equity instrument. Remember, these are phantom share units. However, it does meet a condition under Topic 718 in which cash proceeds received by the employee upon a settlement in an exit event are based, at least in part, on the price of the company's shares. So, upon further review, the ruling on the field stands here as well. This would be accounted for under Topic 718. All right, and we will dive into the last illustrative example here, Case D. I'm sure you all can see where this is going. The first 3 were accounted for under Topic 718. Case D here, similar to Case C on the previous slide, these Class B units did not entitle the employee to receive any sort of equity instruments. Once again, this is often referred to as phantom share units. The holder of Class B units is eligible to participate in distributions of the company equal to 1% of the preceding year's net income, which was different than Case C, in which the holder was not eligible to participate in distributions. The holder of Class B units is not eligible to receive cash upon an exit event, so they're not entitled to any piece of the sale, which is different than Case C. And then similar to Case C here, the Class B units are forfeitable upon employee termination before an exit event, including after the employee has rendered 3 years of service. So I'm going to go ahead and throw my last challenge flag here. whether or not these units should be accounted for under Topic 718. They would not be accounted for under Topic 718 because, similar to KC, they do not meet the conditions because they do not entitle the employee to receive an equity instrument of the company. These are phantom share units. In addition, the other condition under Topic 718 is not met because distributions received by the employee are based on an operating metric, which is 1% of preceding year's net income, and are not based, at least in part, on the price of the company's shares. Thus, this would not be accounted for under Topic 718. And, so upon further review, the ruling on the field is reversed here. So really, just to kind of bring this full circle, a quick recap. Hopefully this helps to serve as an aid for those that might have some of these incentive units within their company or offer phantom share units to their employees to assist you in determining, whether these units should be treated as, a class of equity under Topic 718, or if this is an arrangement that would, be treated separately as compensation, under Topic 710, or potentially some sort of contingent liability under Topic 450. All right, to close out on the Topic 718, ASU's 2024-01, there's two options for adoption of this guidance. One is retrospectively, where disclosures in the period of adoption would cover all periods presented, or two, prospectively, in which you would add a disclosure that describes a change in accounting principle here. Again, this, for non-public companies, this does not become effective for years. It does not become effective until after December 15, 2025. So anyone that is a calendar year end, this would become effective in 2026. All right, the next ASU that I'd like to cover is ASU 2022-04. Supplier finance programs. This was issued back in September 2022. There's new disclosure requirements for entities that engage in these supplier finance programs, including key terms of the program, a roll forward of the activity, and a description of where the obligations are reported on the balance sheet. This is effective for non-public companies for years beginning after December 15th, 2023. So this is now effective in 2024 here for all calendar year-end companies. This is to enhance transparency of the supplier finance programs, also referred to as reverse factoring. Those that are familiar with factoring of receivables, this would be considered reverse factoring or payables financing. Supplier finance programs allow the buyer to offer suppliers the option for access to payment in advance of an invoice due date. So obviously these companies would engage a third party as their finance provider. The next ASU I'd like to cover, ASU 2022-03. Fair value measurement. This was issued back in June of 2022. This, as Jeff alluded to at the beginning of this presentation, some of these ASUs are more applicable to public companies. This is one of them. This clarifies guidance in Topic 820 when measuring the fair value of an equity security subject to contractual restrictions that prohibit the sale of the equity security. It introduces new disclosure requirements, including the nature and duration of the restriction and circumstances that could cause a lapse in the restriction. So, an example of a contractual sale restriction is, a lockup agreement, or often referred to as a market standoff agreement, in which it's a contract between the underwriters and other insiders of an entity during its IPO that prohibits them from selling any equity securities for a stated period of time. This is applicable for all non-public companies with years beginning after December 15th, 2024, with early adoption being permitted. Okay, the next ASU I'd like to cover, ASU 2023-09, improvements to income tax disclosures. This was issued in December of 2023. This enhances transparency and decision usefulness of income tax disclosures. This does apply to all entities. However, the disclosure requirements for public entities are much more extensive than those for the non-public entities. Some of the enhanced disclosure requirements for non-public companies include qualitative information regarding differences between the effective tax rate and the statutory tax rate of the company, the amount of income taxes paid disaggregated between federal, state, and foreign taxes, and lastly, the amount of income taxes paid that is equal to or greater than 5% of total income taxes paid would be another disclosure requirement. This is effective for all non-public companies for years beginning after December 15th, 2025. So a little time here before this becomes effective. With that, I will go ahead and hand it back off to Jeff.
Well, thanks, Eric. We're going to talk a little about a few other updates, and then we'll move into a couple of other topics. Business combinations usually has some activity, and it did again, but not since 2021. It's on the list today because it's effective for this calendar year, 12/31/2024. The whole early adoption provision, I guess, is less exciting if it's effective this year. And what it really applies to is when you buy a company, a buyer buys a target company, and that target company has contracts with customers, there was a little bit of ambiguity, or at least differences of opinion as to how to deal with those contracts and how to account for them. And I think the consensus was, and it became pronounced, that it should be under 606. And well, what do you do? Because sometimes you have to remeasure those and all that sort of thing. They said, well, if you buy a company, if your company buys a company and has existing contracts with customers, you treat them as if you had originated them. So you basically carry over the conclusion, assuming the conclusion was in accordance with GAAP of the target company that was acquired. And of course, like most things, there are some exceptions to that. More exciting, I think, is now we finally talk about crypto accounting and what to do, the disclosures, the measurement, and so on. I'm not sure how many pay attention to it, but I think in the last couple of days, I think yesterday in particular, Bitcoin set an all-time valuation high in the $80-some thousand. So it is, it's been a big deal for a while. I guess it's not the fad that some have thought. Well, until December of last year, the FASB had largely been silent on crypto. They really did not speak to it. The guidance suggested that crypto assets be included with other assets, other intangible assets. It is largely, well, it is an intangible asset, but it be included with other assets at cost and evaluated periodically as appropriate for impairment. Well, they've finally spoken, and it's really not effective until years beginning after January 15th, 2024. But early adoption is permitted, and I will say in the cases that I can think of in walking up here today, where I've been exposed to crypto assets, I think in every case early adoption has been selected because it is kind of helpful, because it was not entirely informative to have a historical cost basis for a Bitcoin holding. So there's a number of things that need to be met to come under the standard for the crypto accounting for crypto assets. And that is that you have to meet certain definitional criteria, definitional and other criteria. And they include things that make sense, like it has to be fungible, et cetera. And I think whenever it meets that, the things that you think will meet it. Think Bitcoin, think Ether, think anything that you would typically refer to as a crypto asset. So what are we to do with it now? Well, as you might expect, it's still not a marketable securities. It's not really treated like marketable securities. It's still another asset, tangible asset. It's to be measured and reported at fair value with the changes in that value flowing into net income in the period of change, as one would expect. Interestingly, and probably very appropriately, the holdings in crypto assets are to be presented separately from the remaining other intangible assets. I don't want to say the word other too many times in a row. It needs to be presented separately from the separate intangible assets. Same with the income effect of the changes. It's to be reflected separately as net income items, but disaggregated from changes in value of the other intangible assets. So, interestingly enough, there's a different, appropriately, again, I believe, this is one that I think is one of the most common sense ASUs, because it actually recognizes that there's a lot of immediate or near immediate conversion to cash holdings of crypto. Not everybody's a crypto speculator. Picture a great example being a nonprofit entity that receives contributions. Pretty much however you will give a nonprofit entity value, they're equipped to accept that, appropriately so. And if you contribute some crypto to a university or a nonprofit, they often don't intend to hold it for speculative purposes. As quickly as practical, they convert it to cash, they monetize it. So that would be near immediate conversion to cash. So the FASB states that those near immediate conversions are to be separately presented as cash receipts on the statement of cash flows. Oops. So we have a number of disclosure requirements, and this is just some of them. The among other things is really a key phrase on this slide. You would expect that we would have the name, you have Bitcoin and you have Ether, then you have whatever and whatever. You would want to know the name, the cost basis, the fair value, the number of units of each relevant financially significant crypto holding. And then to the extent that you have immaterial ones, they can be aggregated. It's okay, other crypto assets, it becomes the name and then the fair value, and et cetera, et cetera. So I think that you can think certain times, kind of like what Eric referred to in one of his examples, there can be contractual sales restrictions. If you can't get rid of it, it makes a lot of sense that would be an important disclosure in your financial statements. Remember, one of the criteria is it's fungible, or at least largely fungible. So if there are contractual sale restrictions for any number of reasons, that is to be disclosed in the disclosures for your crypto. Also, think of an example of level 3 assets when you're looking at fair value, level 1, level 2, level 3, and all of that. And when you have level 3 for the less readily marketable type securities and so on, the FASB is long now required that there be a table in your footnote that discloses what was my beginning balances, what were my additions, what were my gains, my losses, dispositions, and so on. Well, there's supposed to be a similar table for the crypto. Not so hard, but important to do. There's additional disclosure requirements because you have to talk about your means for determining the cost of the crypto assets. What is my method? What is my method for doing my cost valuation? I forget what my first one is, so I better check. If I dispose of it, what are my any dispositions? What are my differences between the disposal price and the cost basis and description of the activities that resulted in the dispositions? Why did you get rid of it? What were your gain or losses? If the gains and losses are not presented separately in the income statement, they need to be presented or delineated in the disclosures. So crypto now has some clarity. So I think that's a welcome change and hopefully not too difficult to apply. Most companies held crypto assets were already managing those based on their fair values. Back to business combinations, the joint ventures. Joint ventures have been another area for which the FASB has been somewhat quiet for a number of years. They've tended to be on an exception type basis. Proportional consolidation was in vogue for a little while, and then it was prohibited. It was different in Europe and in the US. So joint venture accounting has long been a point of discussion. And to some extent, even the definition of joint ventures has not been universally agreed upon. So now we have a definition of a joint venture, and we also have some things to do when a joint venture is formed. So joint venture is defined, actually very precisely, as an entity owned and operated by a small group of businesses or joint ventures. Joint venture can have a joint venture as a separate and specific business or project, because it could be a project, constructing a building or building a dam on a river or whatever it might be, for the mutual benefit of the members of the group. Okay, that makes sense. But people were defining joint ventures differently, and now we have a little more clear definition. Where a lot of the confusion was is what do you do when you start it? Because typically, well, joint ventures would be 50-50 ventures or a third, or whatever it might be. And when people would then say, well, how do we deal with this? How do we deal with this with regard to purchase accounting? So I throw the first 50% in, that's really nothing. I create essentially what's a consolidated subsidiary. It goes in at a historical basis, perhaps. Next person throws their pieces in, and do I have a change in control or don't I? Maybe I do, maybe I don't. So it became a little fuzzy sometimes. And there was sometimes the interpretations of that were less technical rather than opportunistic. We all can be a little opportunistic in our reading of things. So the FASB said, let's make some clarity there, and let's go with the most common sense view once again. Let's just apply the purchase accounting guidance. So whenever you form a joint venture and each side or each party puts their stuff in, their value in, whether it be cash or assets, intangible assets, whatever it may be, you are to treat it with a new basis, just like a business combination. So it gets stepped up, or I guess perhaps down, to fair value at the formation date. So I think that that is a very, very helpful development. And it's actually, it was previously silent, of course, in that initial recognition of that. And I talked about 2 slides at once, so pardon me for that. Internal use software is something that, so it helps to have a 25-year-old's eyes. I will tell you that from up here. There we go. Internal use software. It's one of the few exposure drafts that we've chosen to talk about because I think it's very, very relevant. Just came out, really several weeks ago, and the comments, for those of you who are interested, close in the end of January, a couple months from now. And if you remember what to do with internal use software, or actually software developed for internal use or for sale, really they were largely analogous, that they came from 2 different legacy pronouncements. The whole idea there is when you capitalize it was based on technological feasibility being your kickoff point, and really commercialization or inventory ability being your ceasing point for capitalization. And when those were written in the 1980s, they made a whole lot of sense, and they really kind of captured a lot of what was happening for software development in each of the respective cases at that time. And they had criteria because at that time, before AI and everything else, there were specific processes for software development. You could pretty much determine when you had a working model or a credible outline. I can't remember the official developer's name for it, but a credible outline that, hey, I can actually code this thing. So that becomes a little bit fuzzy or a little more obsolete. And actually, there are some different interpretations or opportunistic implementations of such. And they've morphed that to saying, what do we do now? Well, we still have the concept, but when is it real? When does it leave R&D, and when is it really capitalizable? And the conclusion will be, if this is issued as the exposure draft is written, that the trigger point, the pivot point, will be when the company commits to funding the project. That's when it's serious. The company believes in it. A company typically wouldn't fund it if they believe there's no technological feasibility to it. And also, interestingly enough, because there must have been a number of things that didn't work out this way, in addition to the company, it has to be both of these, it's an and statement, there has to be reasonable likelihood that the project will end with the software being used for its intended purpose, not whoops, it was terrible for that, but we're going to use it for something else. So there has to be reasonable likelihood that it is going to be used for its intended purpose. I don't know what's going to happen. Obviously, they'll close comments in January. It seems like this one ought not to get hung up for the many, many years like the leases and revenue rec did. So we'll look forward to that in the coming months. Now back to Eric.
Thanks, Jeff. And I should mention, this 2 o'clock window is a bit challenging because your lunch is probably settling in, blood sugar's dropping, you're getting a little tired. Hopefully you all were able to grab a cookie, some coffee, and we're in the 4th quarter now, right? So there's 5 minutes left, literally, I think close to 5 minutes left in our presentation, and we have the ball, so we'll close out strong here. The next slide here, tentative FAS board decision. So this is actually even more in a preliminary stage than the exposure draft that Jeff just covered. This was a tentative decision from the June 2024 meeting. They issued their press release on the accounting for environmental credit programs, also referred to as ECPs. The board provided a 90-day comment period on this press release, but as of today, there's been no exposure draft that has been released yet. The FASB did expect to release an exposure draft before the end of 2024 here, so we'll be waiting to see that. It's also uncertain how the recent election results could impact this, or how it could impact this proposal, but we'll continue to monitor this. Some examples, or an example of an ECP would be, an allotment of carbon emissions or credits to certain companies by regulatory or government agencies. Essentially these are the permission slips to offset their assessments. This proposal would provide guidance on how to account for these ECPs. As it stands now, an entity would be permitted to make a fair value accounting election to remeasure a class of environmental credits that are obtained in exchange transactions or through a non-reciprocal transfer that is not a grant from a regulatory agency or its designee. An entity would be required to disclose certain qualitative and accounting policy information about the entity's involvement in ECPs, including the activities that give rise to environmental credit obligations, liabilities, ECOs, and the types of environmental credits owned by the company. The ECP's disclosures would include individually significant environmental credit holdings, such as these permission slips. They would also disclose the individually significant ECO liabilities. And then companies would also be required to disclose the aggregate carrying amount of environmental credits in these ECO liabilities for those that are not considered individually significant. So you can package these together. You'd also be required to disclose the cash paid for any environmental credits acquired, regardless of whether those credits were recognized as assets. Sales of environmental credits would also need to be disclosed, as well as the cost of environmental credits would need to be disclosed as well. Again, this is all still preliminary, and we'll continue to monitor this for any new developments. With that, I will now pass it back off to Jeff to close out the remainder of the presentation.
Little pop quiz. What organization's rules tend to be more arcane than the IRS's? Quick answer, the Department of Labor and its favorite Employee Retirement Income Security Act of 1974. But every now and then they come out with one that's pretty straightforward. And this is one that changes the requirement for audits of benefit plans. And that number remains at 100 participants. We'll talk about what constitutes 100 momentarily. That is in fact a change. And that for a long time that has been eligible participants. So if you had 100 or more eligible participants in your plan, then that plan was required to be audited, and you moved from the shorter 5,500 to the longer 5,500. Eligible participants oftentimes didn't participate. You have a lot of retail establishments and so forth that might have had hundreds and hundreds or thousands of eligibles for every handful that actually participated. Others, like professional service firms, have a very high participation level. And I think through a number of analyses, I said, gee, it might be time to improve that, because somebody who's eligible who has never participated has less need to be protected. So the whole, remember, Retirement Income Security Act becomes less relevant, of course. So that perspective was changed, and it was changed for years after January 1st of 2023. So it resulted, and their goal was to have it result in significant reduction in the number of plans requiring audit. Their target was 10,000 fewer plans needing to be audited. I actually don't know whether they hit that or they were above or below. But the new rule says we're going to look at participants with account balances. So without regard to your eligibility or the number of eligibles you have, if your plan has more than 100 people with account balances, even if they're alumni, then you're required to have an audit. If you have fewer than 100 with account balances, you're not. Now they do have the 80-120 rule, so basically if you now just go over, if you have 90 one year and 110 the next year, you basically get a holiday while you are between the 80 and 100 period, and that rule still exists. There, as always, are a number of things being discussed at the FASB. As always, they enjoy talking about derivatives, they enjoy talking about fair value, and as mentioned at the beginning of the presentation, a lot more relative to public companies of late than the private companies. So with that, Eric and I once again thank you for your time, and we'll look forward to reintroducing Lisa as your MC.